Hello, my name is Maria Bezubova and you are at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video and let's jazz! Today is September 23, 2024 and it is a weekly markets update. Let's have a look at the news of week 38 and see what are the next trends. Last week, Argus Fertilizer Caspian, Black Sea and Eastern European Markets conference rocked in Istanbul, and I was honored to deliver a speech there. Thank you again, Argus team, for the great event. Thank you, my partners and colleagues, for a lot of insightful discussions that I am sure will turn into actual successful business very, very soon. The news of the week that was widely discussed also at the conference is the new Indian tender from RCF, which emerged right after the dust has settled after the long-awaited NFL tender. The next tender was expected later this year, somewhat around end October, but the Indian government decided to surprise the market. The new tender has shipment window through November 20, meaning that it will intersect with the NFL one. The rumors in the market circulate that the tender might attract from 500,000 to 800,000 tons. Such an overlap of the tenders is not usual and perhaps is driven both by active domestic sales in the past month due to supportive weather conditions, as well as deficit of phosphates purchases. The market effect was immediate. Middle East FOB prices climbed to $350 and Baltics indications to $310. Because the same sources from Middle East and Baltics are expected to be key participants. At the same time, suppliers from both origins have massive commitments for October following previous tender. However, these levels for spot sales were not confirmed by the market yet. Another news discussed was gas supply cut in Egypt that resulted in urea production halts at several producers during the week. However, this news was not long-lasting. At the end of the week, the supply and production, respectively, was restored. This situation hasn't influenced market sentiment in Europe much. The buyers are still mostly keeping away from purchases, waiting for more clarity in terms of price trend. Still, offers from Egypt climbed to $365 level and more, with $367 being the highest level confirmed. All volumes for October shipment. New levels that are targeted by Northern African producers are as high as $370, but there is no interest from the buyer's side, at least for now. Iranian producers keep offers level at $295 FOB, but no fresh sales emerged. Other major buying markets like Turkey, for example, were silent with no new demand. Only limited inquiries are circulating, mostly for technical grade urea. Ethiopian Agricultural Business Corporation closed tender for purchase of 250,000 tons of both prilled and granular urea on September 17. Offers were submitted both at FOB and CF Djibouti level, with Fertiglobe, Mid-Gulf and Samsung offering at FOB and ETG Pacific International Trading, MEBEC General Trading and West Trade offering at CIF. Since offers were accepted for 5 individual lots of 50,000 tons each, prices proposed are not directly comparable. For lot number 1, meaning that the one that will be supplied by mid-October, the lowest FOB offer was from Fertiglobe at $348 FOB Middle East. The lowest CIF offer for the same lot 1, according to market sources, was at $355. EABC hasn't made any awards yet. Another conference was held last week in the US, TFI conference in Washington, D.C., which is mainly focused on the US and South American markets. Participants indicated that the demand for urea in the US is quiet and is not expected to pick up much in Q4. Last week, Hurricane Francine hasn't influenced production much, with CF and Nutrien being offline only for several days. Brazil demand is still subdued due to low purchase activity on the farmers' level. However, market players indicate that active purchasing is expected in Q4. About 2 million tons imports figure is circulating. Prices of non-sanctioned material are at the level of $355 CFR, but no actual sales are taking place. Chinese urea production increased to the level of about 195,000 tons per day on the background of improved feedstock prices. But despite stocks building up, there are no signs that export will resume anytime soon. Paper values were skyrocketing clearly on the background of the news. Egyptian FOB values increased by $8 for September to the average of $358, and by $14 for October and November to average of $368. Non-FOB values showed the less of upward correction, only for October and November to the average of $319 for the short ton. Middle East FOB level jumped most dramatically due to the fact that dominating supply for both Indian tenders will be out of that region, that clearly result in certain deficit for spot deals. The average for September increased by $9, while for October and November by $20 to the average of $353 FOB. Brazil CFR also demonstrated rather cool reaction, increasing by $5 to $8 for October and November to the average of $360. Ammonium sulfate market prices are stable both in standard and granular segment. Chinese FOB values were unchanged at the level of $143.45 for standard product and around $160 for granular or compacted. Also due to public holiday in the first part of the week. Chinese players indicate that this week will be important for moving some volumes, because China is preparing for the Golden Holiday week starting October 1, when all market activity will be muted. Brazil demand is slow, but is expected to pick up the same as urea in Q4. Market prices remain relatively unchanged at the mid-$180 CFR level. In nitrates and UAN markets, it was another quiet week with no activity. There are rumors circulating that Yara in Europe is trying to move some ammonium nitrate volumes at prices about €10 lower versus officially announced level, but seems like there is still no buyer's interest. In ammonia, market prices are firming amid tight supply east of Suez. A sales to a Chinese buyer marked the new record level of $465 CFR Far East Asia last week. The fundamentals are pushing prices higher. Also, typhoons are influencing operations with ammonia vessels in China and Southeast Asia, with the Bincha typhoon disrupting shipments. In phosphates, seems like the DAP prices in India have finally moved to higher levels after weeks of pressure. DAP purchase tenders by NFL, HERL and RCF all indicate to DAP values in the high $630 CFR, up by $10 versus what was fixed before. Product origin is understood to be Chinese and Saudi. Offers out of China have not moved much, and I heard at $615 to $20 FOB. The Indian government formally approved NBS rates for Rabi season, although the breakdown of the rates for each product has not yet been announced. This is what everyone is interested in, particularly for DAP, of course. In total, the government has committed almost $2.9 billion for the upcoming Rabi season. Under the revised nutrient-based subsidy scheme, these subsidies will be in effect from October 24 through March 25, covering 28 grades of P and K fertilizers. Here, the proposed changes, however, final details are not available yet. For nitrogen, subsidy to be reduced by 9% from Kharif 24 to 43 rupees per kilo. Phosphate subsidy to be increased by 7% to 30 rupees per kilo, although DAP subsidy will be cut by 13%. Potassium subsidy expected to remain unchanged at 2.38 rupees per kilo. Sulfur subsidy to be cut by 7% to 1.76 rupees per kilo. During Kharif 2024, a special package of 3,500 rupees per ton for DAP boosted the total subsidy to 25,175 rupees per ton. A similar package for Rabi 2024 is expected, but details are still pending. Due to DFI conference in the US, there was no much market activity last week, with DIP values still held at $550 to $55 FOB per short ton. Brazil market has also not seen any activity since last week, when a small quantity of MAP was sold to the country at $635 CFR. Moving to the fundamentals. The key news of the week arrived from the US, where Federal Reserve conducted its first interest rate cut since early days of COVID pandemic, slicing half a percentage point to the level 4.75 to 5%, and could lower it by an additional half point by the end of the year. Lower rates should bring billions in new long-term investments and create thousands of new jobs. It shows that Federal Reserve is convinced that inflation is coming under control. It signals the economy has recovered to a faster, sustainable growth trajectory and is ready for further investments and job creation. Such move should push not only the US economy, but also help to bring more light to the gloomy international scene. The highly responsive and volatile US stock market already hit record highs at closing on Monday and Tuesday, as investors prepared for the Fed's rate cut. A rate cut will also weaken the dollar, which has fallen against most major currencies over the past year in anticipation of the Fed decision. A weaker dollar will make it easier for US firms to export, but the broader improvement to the global economic outlook will benefit the global economy. European natural gas futures dropped lower than 32 euros per megawatt hour during past week, but then rebounded to 34.6 on Friday. There are rumors circulating around the potential deal for transportation of Azerbaijani gas to Europe as a temporary measure following the end of Gazprom 5-year deal. Prices were also supported by expectations of a cold snap later in the month, enough to raise gas demand for heating power by 8 million cubic meters per day. On the other hand, Norwegian gas flows to Britain have increased as the Langeld pipeline is fully operational after maintenance. In the US, Gulf Coast energy facilities were restarting after Hurricane Francine, with ports reopening and oil and LNG tankers being accepted. The latest data showed that European gas storages were nearly 93.5% full ahead of the winter. US natural gas futures dropped during the week to the level lower than $2.2 per MMBTU, but then rebounded on Friday. Natural gas demand typically dips during the shoulder season, September and October, when neither heating nor cooling is needed. Looking ahead, though, producers are expected to cut output in late 2024, following a 40% price decline over the past 2 months. Agricultural commodities future prices showed diverse dynamics. Despite the International Grains Council lowered its global wheat production forecast by 1 million tons compared to last month, now estimating 798 million tons, the pressure on prices coming from the Russian wheat in the Black Sea continues. Russian wheat price remains stable while other benchmarks increase. At the same time, in the US, total outstanding sales and accumulating exports of all wheat classes for the 24-25 marketing year have reached 11 million metric tons, which is 28% ahead of last year's pace. The USDA projects US wheat exports for 24-25 season to be 22.5 million tons, with current commitments accounting for 49% of the total projected exports. Corn futures have retreated to around $4 per bushel from a 7-week high of a week ago, driven by oversupply concerns and weak demand. Despite some short-term gains fueled by market volatility, technical buying, spillover support for wheat, and a weaker US dollar, the broader outlook remains bearish. This is compounded by an economic slowdown in major economies, dampening demand prospects. Soybean futures fell slightly on Friday amid early US harvest pressures and strong import numbers from China. Soybean sales jumped to 1.75 million tons by 20% from a week earlier. China was in for almost 1 million tons, followed by Mexico that bought 167,000 tons. The total would have been higher, but Argentina cancelled orders for 88,000 tons. In Brazil, soybean planting has started, but elevated temperatures and low humidity has hindered the producers. Moving to the shipping industry. Containerized freight index continues slipping. It lost almost 6% last week again. The largest loss was on the route between Shanghai and Rotterdam, indicating decrease of trade activity between Europe and China. On the contrary, rates between Europe and US even increased a bit. The Baltic Exchange Dry Index marginally climbed during last week. The Capesize segment experienced a week of mixed activity, highlighted by a strengthening Pacific, South Brazil and West Africa to China routes, while the North Atlantic market struggled initially. A cautiously optimistic week was for Panamax market, as period demand crept into the market, with Atlantic routes the most prominent risers. This was largely led by solid mineral and grain demand, especially from the US Gulf. Mixed fortunes this week for the Ultramax and Supermax sector. Handysize segment also showed mixed performance last week, as activity picked up in the US Gulf, leading to slight increases in the rates. However, owners with vessels open in the South Atlantic continued to face limited options, with negative sentiment persisting throughout the whole week. Other news related to shipping segment came from the US last week. The ports on the east and Gulf coasts are on the verge of a significant disruption, as dock workers threaten to strike on October 1st. The union that represents the dock workers is seeking substantial wage increases and firm commitments against port automation, which they argue could threaten jobs. The Biden administration has stated that it will not interfere to prevent the strike. The decision has stirred concerns in the various industries, as a strike at these key ports could lead to widespread supply chain disruptions. The East and Gulf Coast ports manage a substantial share of US container traffic, as well as other bulk and liquid goods, including fertilizers, of course. So, let's watch the situation development. To sum up, after months of bearish sentiment in urea, 2 Indian tenders announced one by one clearly spurred the momentum. October and November will definitely be relatively deficit, but further price dynamics will be dependent on the volume secured in the second tender announced last week. Ammonia price level continues surging, especially in the east, due to outages of modern product. India announced first news about changes in the subsidy system for the end of Kharif and Rabi seasons, but no exact details by product are clear yet. So, phosphates market is awaiting, being rather in the waiting mode with no major deals or price changes. Historical Fed interest rate cut is expected to push not only US, but the global economy in general, supporting the investments and helping US exporters with weaker dollar rate. So, let's watch the outcome of this move in coming months. Growth of agricultural commodities future prices reversed after 2 active weeks of technical buying, because immense supply still dominates at the sluggish demand. Situation in the gas market seems to be cooling down, with less concerns about the future supply to Europe and very healthy stocks in front of the winter season. Containers logistics cost continued decreasing, while dry bulk shipping showed more or less stable performance last week. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon!